If you made it to the third webinar, congratulations. I'm so excited for you. And I hope that you're able, by the end of this, you're able to have a better grasp on your financial statements. That's the point.
Hey everybody, Neil. So I see you're in Louisville, Kentucky. We're going to be at the Equip Expo again this year, so look forward to seeing many of you guys there as well. All right, so we're seeing some numbers all across the board. You know, I think similar to some of the other webinars that we did, these previous two webinars, you know, I think, you know, whether you're really trying to learn different aspects or you're just looking for some little tweaks, you know, we could definitely, you know, I hope add some value in either scenario here. But for those that are not aware of who Carl and I are, so we're the co-founders of Cycle CPA. We run a fully remote accounting firm. Our team works from home, right? And we work specifically with green industry companies. And you know, so companies all the way from lawn care, landscape, all the way to outdoor living, hardscape work, irrigation, tree care, and yeah, really, you know, big, you know, one of our goals here is to kind of pass on some of the things that we see in the industry, you know, in regard to things to watch out for, and you know, really pass those on to everyone here. So, you know, looking forward to kind of diving in. And if you weren't able to make the two previous webinars, or if you weren't able to kind of watch them or the full amount, we'll be sending those recordings tomorrow. So just keep an eye out for those via email.
Yeah, no, super excited to dive into the cash flow statement. I know a lot of people are interested in this one because it's talking about your cash at the end of the day, right? Something that is tangible and you're able to see in your bank account. But we want that deeper understanding and how we can better manage it, how we can analyze it. And so, you know, we'll go over that here. So if you have any questions along the way, feel free to use the chat, please. Thanks.
So has it ever seemed like you were making a good amount of profit in your company, but when you look at your bank balance at the end of the day, it was a little lower than you had expected, right? And this is where, you know, looking at your cash flow, it helps to kind of answer this question. And, you know, similar to the P&L and the balance sheet, the more granular you're able to get, the more you're able to kind of dial in and then make those improvements to your company.
Yeah. And I get that question a lot. It's like, hey, Carl, I have $50,000 in profit, but that's not how much I have in my bank account. So where is that disconnect? And so the statement of cash flow helps you fill in the blanks and where that disconnect is. So the statement of cash flow, that report, it has 3 sections. The first section being the cash flow from operations, the second is cash flow from investing, third, cash flow from financing. And so I guess firstly, defining cash flow, right? Very easy. The money that's coming into your account and the money that's going out of your account, right? And so the cash flow from operations is what, you know, your daily like expenses that you incur in the business, the ordinary expenses that you incur in the business. So some examples of the cash flow from operations could be like AR, accounts receivable, money that you receive from clients, right? That owe you money. Accounts payable, money that you pay out to your vendors like Sheffield, Site One. And then depreciation as well, right? So that is the wear and tear on your vehicles, machinery, and equipment, all of that. Even though that's not a cash transaction, that is still in there so that we can reconcile the profit and loss. And I'll go deeper into that. And then the second section is cash flow from investing. So investments into your business, like when you make an equipment purchase. So if you purchase a skid steer, truck, trailer, all of that would be in there if you put money down, right? And then cash flow from financing. So if you applied for a loan, a vehicle loan, or equipment loan, that would be in that section. And then at the end, you would see the cash at the beginning of the period, the money in your bank account, let's say January 1st, 2025, cash at the end of the period, cash in let's say today's date, April 9th, 2025, and then the net cash for that period. So positive means that you have more money in your bank account today. Negative means that you have less in your bank account today. And of course, we're always shooting for that positive cash flow. We want to have more money in our bank account. So here's an example of the statement of cash flows, that report that I just broke down for you guys on a yearly basis. But again, a cash flow statement, you could look at it from a yearly perspective, like we're doing here for 2024. Or you can look at it from a monthly, quarterly perspective. My recommendation would be to look at it monthly, right? At least monthly. So I'm just going to take you guys through this. So this one's for the year for a company. So we start off with net income, 110,000. So net income, we get that number from the profit and loss. Remember when I told you, like, some people ask me, like, my profit is 110,000, for example, but that's not what I have in my bank account. In my bank account, I actually have $1,400. Like, where is the disconnect? That disconnect is here, right? And so the cash flow statement is telling a story about your business's cash and where that cash went, right? And so starting for the adjustments to operations, right? So it's going to add your accounts receivable, money that you got in from your customers, of course. It's going to add back the depreciation, because depreciation, it's not a cash transaction. You don't like physically pay for depreciation, but it is on your profit and loss as an expense. But it's not a true expense because, again, you're not paying anybody for your depreciation expense every month. So that gets added back. And then here you see like a negative here for credit card payments that you made to Bank of America. You know, you paid back your credit card to Chase, whatever. So that's why that's negative. That's going to decrease your bank account balance. And then some payroll liabilities that you may have had for payroll. And so the net transaction is negative 2,500. So what this is saying is, overall, for the operations of your business, you actually spent about $2,537.96. So the money that you got in from your clients, right, minus all the expenses that we spoke about, like the credit cards, all that, and accounting for that difference for the depreciation. So that's why it's negative. So here is where we want to see a positive, we want to strive for a positive, because we want to try to collect from our clients enough revenue to cover these expenses here. So if this company would have collected $2,537 more from their clients, they would have broke even with their cash flow, right? Or if they would have collected more from their clients, like $15,000, then they would have had a positive cash flow. Does that make sense? So that's that from operations. And I'm just going to clear some of my drawing there. How do I do that? All right, we'll move on. But the next one is investing activities. Okay, investing, like I said, is money that you invested into your business. So in this company, they purchased some computers. So that's why you see a negative $15,000 there. They purchased machine and equipment worth $25,000, and they purchased some vehicles for the year for $35,000. So of course that's going to lower their cash, right? So it lowered their cash by $75,000 for the year. So that's also a negative. That brought their bank account balance down. And lastly, we have financing activities. So these are some of the loans. So like this business has an SBA loan, and their loan payments for the year totaled up to $1,531. So they paid back some of that. And then they also had a loan on their vehicle, which totaled up to about $3,400 for the year that they had to pay that back. And so, of course, the loan payments come out of your bank account. So that's going to be a negative. That lowers your bank account balance. And then they had some owner's draw too. So it looks like the owner took out some money from the business to pay themselves. So about $34,000 there. But they actually also contributed some money to the business, about $5,000 there. So if you contribute money to your business, you deposit funds into your business from your personal, that is a positive thing, right? It's going to increase your bank account balance. So the net cash provided by financing activities is also a negative. So more money was taken out for financing activities. If we add all of those up, it's about $34,000 that we spent in financing, which could be an interesting number for you to see for the year. How many loan payments are you making for the entire year, right? So so here at the bottom, these last three numbers is where it's going to summarize everything. So at the beginning of the year, I had $3,300 about in my bank account. So I started off with $3,300, but I ended with $1,400. The difference is $1,945. So I ended the year with the bank account balance at a lower amount than I had initially. And, you know, the reason why is because of all of these adjustments that I just went over. So you can see how this 110 quickly declines with all of these considerations taken into place, right? So that's how you can look at where your money went for the period. Oh, you're on mute, Joe.
Sorry about that. So when you're looking at cash flow, one of the items to look at, especially when viewing it from a short-term perspective, is what's called your working capital. Now, these are the funds or the capital of a business, which really you as the business uses or needs on a day-to-day basis to perform your operations. So the equation for this is your current assets, right? So things like cash, accounts receivable, minus your current liabilities, right? And these were items that we had covered, in the more in depth in the balance sheet webinar and the previous webinar. And ideally, you want your current assets to exceed the current liabilities, right? Because ultimately, you want to make sure that you're covering a lot of those short-term liabilities and payables that are coming due. And you can also express this through the current ratio, which is the current assets divided by the current liabilities. And ultimately, you want to be over 1.5 with this, right? So, this is a way that you can really measure this and track this over time and see, okay, how is our working capital doing over time, especially as we're viewing it as a trend? Are we in the mark that's going to allow us to kind of scale and continue to grow based on the short-term cash flow perspective? One of the other biggest considerations is within the green industry. It is interesting because there's different business models. And although it's considered maybe the green industry, a company doing lawn maintenance or lawn care, or even if it's a service line that you perform, is entirely different business model from more of that one-time work or install and construction type of work. So it's important to understand the cash flow ramifications behind those, right? So a company that's doing a lot of install-based work, cash flow is going to be a lot more top of mind, because that's just the nature of that business. You're having to pay for a lot of materials up front, and making sure that the progress payments are being scheduled out and collected. And we've even had companies add on service lines that are more of a recurring basis, just to be able to continue to scale their current operation in regard to the installs. So it's something to consider. And even as you look at bottlenecks within the company, if your bottleneck is cash flow, like some companies, their bottleneck might be recruiting, or might be getting clarity into their numbers, or it might be training, or it might be marketing and trying to get some of the leads. But if your bottleneck is cash flow, you need to really dive in and see, okay, what are ways we can improve this? Maybe it's changing the payment structure, right? So if it's an install-based company, trying to get more upfront, or trying to increase the frequency of the progress payments, adding an additional service line, so it's really thinking about, okay, if that's the biggest bottleneck, how can we solve it? What are the ways we can improve for next year? And sometimes, you might not be able to solve the entire issue that you're facing in regard to cash flow for that particular year, but just making those slight changes year after year. We've had a company that was able to go from using a line of credit for 3 months out of the year down to 2 months the next year, and then down to 1 month the year after, right? So it's always trying to improve year after year. And now we're going to walk you through an example of two landscape companies, financials, starting with the P&L, and then we're going to work our way to the other financial statements, just kind of showing how not only do they relate to each other, but just the importance of also dialing into not just your P&L and balance sheet, but also looking at the cash flow picture of the company as well. So starting over here in company A, you can see this company is able to actually generate a higher net profit. Why is that? Because their gross profit, so they're managing their operations more efficiently, or maybe their pricing is adjusted where their gross profit is at a higher level. They're at around a 44% mark, whereas, and let me just adjust my screen here. So they're at around a 44% mark for their gross profit, whereas company B is at a 41%. Ultimately, company A is able to generate a higher net profit.
Okay, perfect. So thanks for taking us through the profit and loss, Joe. Now, this is the same companies, just going over the balance sheet. Again, company A has 15% profit, and company B on the right has 12% profit. So the balance sheet, we see here that company A has more assets, right? So they have more resources to pull from. And then company A also has more liabilities. They owe more people than company B. Company A has more equity though, which is a good thing, right? Again, equity is what you own in the business. Again, we went over this in the past last webinar last week. and company B has less equity. And then, going through some of the ratios down here relating to the balance sheet. So return on fixed assets. So return on fixed assets is how well your assets, so your machinery, equipment, and trucks, are providing a profit for your business, right? How well are they generating with the profit in place? So we can see that company B is knocking it out of the park. They're doing very well with that, with their current assets that they have in place. Return on equity. Remember, this is the return of what you're making in the business, right? As the business owner, you want to make a good return, right? Because you put a lot of sweat equity, you put a lot of work into your business. So you want to make sure that the company's also providing a good return for you and your family. And we see that company B is doing better than company A. Liquidity. So this is how well the company can pay its current obligations, like sales tax, payroll, their accounts payable. So maybe, how fast that they can pay their Site One bills, stuff like that. If they're able to cover their cash flow needs. And you can see that company B is doing a lot better than company A. Debt to equity. How well is the company managing debt? So we see that both are doing the same, right? So even though I think what the biggest takeaway here, even though company A has a higher profit margin, company B is managing their cash flow better, right?
And their balance sheet is ultimately in a better position.
Yep. All right. So the next thing is looking at the cash flow statement for these two companies and seeing, okay, we already know that company B is ultimately, like I said, and I think I jumped the gun on this, but managing their cash flow better, because you see that they ended with a 9% cash flow, while company A ended with 7%. At the beginning of the period, they had 20,000 in their bank account, and now they have 91,000. So they have $71,000 more, where company A only has $52,000 more. So I guess the big question here is, like, how is it that company A was able to be left with less in the bank, but they had more profit, where company B had less profit and had more money left over in the bank account? And so I'm going to go over key reasons why, because we see this a lot. So just starting off here, we have for company B, we have a decrease in accounts receivable of 45,000, and so that means that they got paid, $45,000 from their clients, and company A got paid $60,000 from their clients. But the increase in the accounts payable is $100,000 from company B. So this company paid out, less, and the depreciation on company A though is more. So it looks like the company A had more assets. So they had more machinery, equipment, trucks, trailers, all of that, than company B did. So that's one thing, right? The next thing is that company B spent less money on assets. they spent $25,000 on an equipment purchase, but company A spent $30,000. So it looks like they were able to make a smarter choice, a leaner choice on some equipment purchase. And then financing, which ultimately is another big aspect here, where loans really make a difference. And I think this is what we try to get across to a lot of the businesses that we work with in the green industry, is that the more fixed expenses you have in any business, right, the harder it gets to manage cash flow, because those payments are going to come out no matter what, right? No matter whether it's a slow time or a busy time. And so it becomes hard to manage those. And so ultimately, I know that we have to have some loans, but if we can purchase things in cash, then we can lessen that burden, right? And that's exactly what company B did, is that they only have $23,000 that they pay out in loans every year, versus company A has $30,000. So company A has more of that financial strain on them. And of course, that all of these items with AR, collections being slower, and having more depreciation, having larger purchase in equipment, and having more loans, ultimately, for them, it caused them to have less cash flow than this company that had less profit. So sometimes, even if you make less profit, but you're really good at managing your cash, as we see from here, then you could ultimately have a higher cash flow percentage, right? And so I think it ultimately comes down to the planning, the decision making in the business, and being able to get creative with things as well, right? I love when people get creative with stuff. Like, I know there are some companies that we work with that will have rent, but they are sharing that rent expense, right? Or they do have equipment purchases, but they purchase used rather than new. Or they may be renting or leasing, just depending on the business model, right? But I think one thing that we see here is AR. If you're more efficient at collecting and you have a good accounts receivable process in place of following up with your clients, texting your clients, emailing, and really trying to collect payment as quickly as possible, that also affects your cash flow. If you can get each one of your clients to pay 5 days sooner, it's going to completely change the game for you as far as cash flow goes, right? And there are a bunch of different things that you can work on that will move the needle. Like I mentioned, it's not just one thing, accounts payable. Like, how can you get more efficient with your accounts payable? Maybe one thing that company B did that company A didn't do is they negotiated with their vendors. So instead of paying them within 15 days, they pay them within 30 days, right? Or they extended that to 45 days, right? Or they use their credit cards more efficiently, or strategically, I should say. So all of these things really help with cash flow. And I hope that you guys were able to see from this example how you can better manage that and how it would really affect the cash at the end of the day that's in your business bank account.
Yeah, and we're going to go through some of the industry median data in regard to this, but it's an interesting thing to think about, that a company that's doing 20% net profit from their P&L could actually be doing 0% net cash flow. That's a possible scenario, right? So it just makes it even more important to, manage the financing aspects, and, making sure that even when it comes to the equipment purchases, right? You have a lot of situations where a tax CPA might recommend to purchase something at the end of the year, but what are the ramifications on cash flow?
Right.
Not only that, are you getting the right equipment for the jobs that you're performing, right? Just as you want to build up your team to be able to match their strengths with the work that they're doing, whether it's on projects or whether it's on the administrative side, the same thing goes with the equipment, right? So again, all things that are going to play into looking at your net cash flow. And Carl and I like this report because it shows really, why you need to, especially even if you're going to go purchase a company one day, or maybe, like maybe you want to purchase a company, right? These are things that you also need to look at to kind of see what that reality of the company looks like. So again, in regards to the benchmarks, when you look at, starting on the left side, when you look at more of the install-based companies, back in 2024, for companies above 500,000 in revenue, roughly, these, your gross margins around 40%, net margin around 5.5, and your net cash flow, unfortunately, the industry median is 0%, right? And that's why we're happy to see so many people here, watching these webinar series, because I ultimately believe that it's people like yourselves that are going to be able to, even if you're at 0% now, that you can make those changes. And we see that happen all the time. I know even a company that I was just looking at, they went from negative 2% profit last year to 11%, and even their cash flow increased at almost a similar rate, right? So it's stuff that we see happen all the time. So even if you're in that situation right now where you are at a low cash flow level, just understand that sometimes it just takes those different tweaks within the company. And even on the maintenance side, so you can see similar, where that net cash flow metric is actually closer to around 0% for the industry median. So, which also makes it even more important that your net profit is high, right? So as we discussed in the profit and loss webinar, shooting for that 15-20% at least, because the net cash flow is typically going to fall maybe 5, 6, 7% lower on average. So something to keep in mind there. Also, when you're looking into cash flow, similar to a lot of metrics, but especially with cash flow, looking at those trends, right? And trying to determine, okay, what are those months of the year that are low? And typically you might even know this or have an idea without even looking at a trend graph, but sometimes it helps to show you that pattern. And like I said before, with that one company that was using the line of credit for 3 of the winter months, now they only use it for 1, right? So it's trying to determine, what are some of those things? And in this scenario, maybe it's more of that off season, right? So adding on additional services, or trying to adjust also, I think too many companies are, paying your people even when you're not producing any work, right? In some of those low times, which can dwindle your profits incredibly quickly, right? So trying to find a way to, make adjustments there could have a huge impact. And then also when it comes to cash flow, making sure you have a good cash on hand, because that's going to allow you to stay more in the offensive mode and be able to continue growth, right? So typically what we recommend is 2 times your monthly overhead costs to have set aside. And if you're growing faster, then that's going to mean that you're going to need more funds set aside, especially, for instance, if you do more of install-based work. Right. So versus a company that's not growing that much, that does more of the recurring maintenance work, you could be closer to that 2 times your monthly overhead cost. So again, understanding your specific business model, looking at the trends from last year, determining, okay, where were we? What are our goals for this year? And trying this year, especially as we're entering the end of the spring and the summertime, when things start to look good, you're making 20%, 30%, even 40% net profit for that given month. Understand that when you look at that from a year perspective, it could actually just be a 15% profit, right? So really trying to think about, okay, what are those saving goals each month that we want to hit to make sure that we have a healthy cash on hand at all times.
Yeah, that's a good point that you bring up, Joe. And we do recommend 2 times your fixed expenses, which you know will help you get through some of those maybe less busier months or something like that. But we just had a scenario this at the beginning of this year where one of the business owners we work with didn't tell us that they wanted to all of a sudden grow for 2025 like an exponential amount. And then we're like, whoa, we don't have enough like cash reserves to be able to make this happen. So then we had to get creative with some debt and some equity and stuff like that. We're ultimately able to make it happen. But I think you brought up a good point, Joe. Like, yeah, two times fixed expenses it's a conservative amount, but it won't cover like a scenario where if growth is in mind, then you would need a little bit more savings with that for sure.
Yeah.
Okay, perfect. And then people always ask me like, how can I better manage my cash flow and be better prepared for those ebbs and flows, especially in the green industry where we know some of the seasonality that takes place, whether that be in the winter or just in the drier months, even in the summer, right? So I think it's important to be able to manage that and monitor it closely. And the number one reason why businesses go out of business is because of cash flow purposes. So you better bet that if I know that, I want to have a plan in place to make sure that doesn't happen to my business. And that's why we came up with a cash flow forecast tool to help you better manage that. And we get a lot of positive feedback from this cash flow tool. And it's something that you could just build on Excel. And it's super easy. It's not complicated. And let me just walk you through how to read this. So we're first starting off with your total inflows. And then you could do this on a week-to-week basis like I did here. But inflows means the anticipated money that's going to come into your account, right? So what are some inflows? So AR collections, like you're saying, like maybe there are some services that I invoiced, but I haven't received the payment yet from my clients. So, but I know that, Mrs. Smith said she was going to give me $13,000 this month and this week, and I know that I'm going to collect another $8,000 in the upcoming weeks. Or maybe if you're a maintenance company, you have that recurring, like Joe mentioned, cash flow. You know that every first of the month you automatically debit your client's account, and I automatically have $13,000 in the bank every first of the month, and that's where the positive outlook when it comes to the recurring services come from a cash flow perspective. Like if I can rely on that 13,000 every first of the month, then I can make plans, right? So that's where that level of comfort comes from for a recurring service. So if you could provide or make any of your services on a recurring basis, that's huge. And so on the flip side, if you have maybe design build services or something like that, where you're more get upfront deposits for your work, that you can look at your pipeline and see, okay, I know that I'm getting $10,000 worth of deposits this week. I have these few jobs scheduled out. I know that this is how much I'm going to receive in deposits, right? So you would want to look at your CRM to look at the contracts that have been signed, the money that's going to come in and been projected. So CRMs like Element are synced up, where it's going to tell you, okay, these contracts are ready to go. I know that I'm going to get $10,000 in the next week, right? And then you can pop that number in there into your Excel. So that's all of your inflows. And of course, there are a few other inflows. So let's say that I take money from my personal account and I'm going to funnel it into the business because I just want to fund my business for growth. I'm going to take $20,000. That's also an inflow. So if you're going to have that type of situation, you could also pop that in there, which is, not typical, but that's another thing. Or if I take out a working capital loan, or a line of credit that I'm going to pull from, that would also be money that comes into my account for operational purposes. So that money would also go in there. And then we'll move on to direct cost outflow. So the money that's going to come out of my bank account. So if you run payroll, if that comes out weekly, you know about how much money that is per week or every other week. Like this company knows that they're going to approximately have $25,000 on a bi-weekly run of payroll. That's how much they're going to spend. Your bills, right? Like materials, how much am I going to approximately spend? Like if I look at my invoices and the bills that I sent over that I have, I know how much I spend on a week-to-week basis as well. If you don't have like bills coming in and you spend your money on the spot via your debit account or something like that, you can look at how much you're spending on materials on average and seeing that as well. Subcontractors, this client pays them on a bi-weekly basis as well, so that's why that's in there. And then if I'm going to have any equipment rentals too, and just any other miscellaneous costs. And so that's how I get, and then obviously you want to allocate them to the correct week, right? And then that's how I get how much money is going to come out of the bank account. And then I do the same thing for overhead. And I think the overhead is so much easier to forecast out because you know that your AT&T bill is due every 5th of the month, for example. So you're always going to have that cost, that $100 on the 5th of the month and so on and so forth. But the biggest item here that a lot of people don't account for is the balance sheet items. So that's what I was talking about earlier, where you have your loans. So that's not on your profit and loss statement. That's on your balance sheet. So those are costs that you're not seeing on your profit and loss and not taking it into account in your net profit. So it looks like this company has a Sheffield loan, hits every first week of the month, $450. Ford Credit, Kubota. They also make a $1,000 transfer to their savings account every first week of the month. So that's what they have that accounted for. Credit card purchases, yard card payment, stuff like that. Things that, again, are not on your profit and loss statement, but ultimately affect your cash flow because all of this money comes out of your bank account, right? So then you get your total outflow. So what this does is it's adding all of the money that you're spending, whether it comes from the balance sheet, the overhead, the direct costs, and it's taking the money that, the total outflows, and then you're going to get your net cash flow. So the net cash flow is the money coming in minus the money coming out. And then if you see that, in week 1, I have a positive amount, right? Week 2, it looks like more money is coming out of my bank account. Week 3, more money is coming out of my bank account. So for those weeks, I want to find how can I book more jobs so that I get more deposits up front, right? Or ultimately, how can I book more jobs so I can level out those outflows, right? So I think that having a tool like this helps you plan for those ebbs and flows, right? It helps you anticipate those shortfalls. I can time my expenses better. So let's say that I want to take my team out to a nice dinner, or I'm going to make a large purchase like a truck and I'm going to put a down payment. Maybe I would do that on the first of the month, on the first week of the month, right? Because I have a positive there. But if you're looking at this on a month-to-month basis, you'll be able to see that as well too. It helps with the trends analysis. So maybe every fourth week of the month, I really struggle, right? So maybe I need to come up with a creative way on the fourth week of the month to come up with some better cash flow strategies, whether that's using my credit card, booking more deposit payments or something, or jobs on the fourth week of the month. But yeah, that was the cash flow forecasting tool. If you guys have any questions or anything, please put them in the chat, and we'll get to them.
Very nice. Yeah, we're going to send all these recordings tomorrow, so that way you can all review them. And I hope everyone has is having a great spring thus far. I'm hearing, definitely, a lot of our clients, a lot of people I'm speaking with as well, starting to be pretty busy. So it's what we love to see. And I know there's some different things happening within the economy right now, but my recommendation is trying to just keep your head down and trying to just really dial into your operations within your company. I think there's a lot of things that are controllable, that you can influence. So, just really starting there, and I think it's going to be a great year.
Somebody asked, does the QuickBooks statement of cash flows show me anything worthwhile? And it does. The statement of cash flows that I pulled up, that we showed initially, was an example of what you can see on QuickBooks. And it, like I said, it just puts together like where your money went, because the profit and loss won't show whether you put money down on a truck, right? Or won't show your loan payments as clearly. So it's definitely a strong tool that you can utilize to identify those purchases that you make but are not reflected on your statement of cash flow. So I can share my screen and show you what it looks like on QuickBooks.
And Hillary, I know you had, so Hillary mentions that cash flow is definitely the biggest struggle. It's either feast or famine, right? And I think that there's a lot of companies that are in a similar boat. And I think that especially after viewing these webinars, I would love to say that it's due to one thing, right? But sometimes it's really dialing in and understanding that the cash flow issue, it's trying to think about, okay, what are the 1,000 things that can influence it? Then basically narrowing that down, right? And trying to see, okay, how can we approach it and how can we make changes? Because that's one of the biggest things is we don't want it to be feast and famine for you every year for the next 5 years, right? Trying to really determine, okay, what is the issue to this? Maybe it's actually maybe your accounts receivable process is fantastic. The clients know the expectation. Your internal team knows how to tell the clients about the progress payments, or maybe the efficiencies in the field are fantastic, right? Maybe it's actually a pricing issue, right? The pricing is not allowing you to make enough profit to make that cash flow, right? Because if you're looking at some of these cash flow metrics, right, a company that does 10% net cash flow, if your profit's off by 10, 50, if your pricing is off by 10%, right, there goes your cash flow, right? So it could be a lot of different things, and that's why, it starts with, I mentioned in the profit and loss webinar, in the first one, start with that bird's eye view, right? And then dial into what can be, what can potentially be that issue.
Yeah, and so For those of you asking, like, where could this be found? So on your QuickBooks, you're going to go to reports, and then you're going to click on standard reports. In here, on the type, you're going to start typing statement. Here, statement of cash flows. And so you'll be able to pull it up here, and you can, you know, if you wanted to, you could just look at April, you know. Well, you need to make sure your bookkeeping is done, right, through April 9th. But you can look at it from the beginning of this year through today. And this report, like I said, starts off with your profit. And I think one of the things that is eye-opening from this report is that, you know, this company purchased a truck for $13,495. So this number is not on the profit and loss statement, like, because this is on the balance sheet. So it's negative because that money came out of your bank account, right? So it's decreasing. You know, they have a few loans. They took money. I think they took money out from their business account. So you can see, okay, I took $14,000 out from my business account. Or if you have personal expenses, like you went to Macy's or something, that would show there, because that's not on your profit and loss, right? So I think it's powerful when I know how much I spend in loan payments every month. You know, did I make that big asset purchase, and ultimately how it impacted my balance at the end of the day. So it looks like this company started off with $4,800 on January 1st, but as of April 9th, now I have $4,000. So overall, my bank account balance decreased by $788.
Yeah, so you might look at that negative $788 and say, oh, wow, that's really bad. But maybe January 1st to April 9th of 2024, so the year prior, maybe was negative 50,000, right? So that's why it's always good to look at those trends and understand that, okay, even though we're not in the place that we want to be, at least it's trending in the right direction. And, you know, so yeah, I think that's a great point, Carla. And Terry has a question. So if I was to get help from a bookkeeper here in town or online, how often would expect to meet with them? Weekly, monthly? So typically, so it's like our initial service offer, just to kind of use it as an example, Terry, you know, it's more of a meeting on a quarterly basis to go deep into the financials. That's not just a meeting just to look at your P&L or just to, you know, say, hi, what's up? It's a very comprehensive report that we kind of go through to really help to drive change within the company. So I recommend, you know, quarterly meeting. If you start to get, you know, really into that high 6-figure, 7-figure range, I think a monthly meeting makes even more sense. But even companies that are smaller, if you have certain bottlenecks on the financial side, so maybe it is a cash flow bottleneck, a more frequent meeting makes sense. Yeah. You know, larger companies, you know, you're having those weekly meetings to manage cash flow, AP, AR, right? So it's, you know, different steps of the game. But I would say at the very least, a quarterly meeting would be a good start.
Yeah. And if your accountant's currently not meeting with you monthly or quarterly, I think even making sure that they're sending you these financial statements at least monthly, right? Your profit and loss, balance sheet, and your cash flow statement. Because if you get them monthly, then you can make decisions based off of them quickly. You know, the faster the feedback loop, the better, right? So making sure you're getting financial statements on a monthly basis is huge as well. So awesome stuff.
Very nice. Well, we'll keep everybody in tune for our next webinar. Haven't decided the date or topic yet for it, but you know, we'll definitely let you all know. It's been a pleasure to be able to do these 3 webinar series, webinars in this series, and you know, I really hope that you all got value from it, and I really hope that you're getting some serious business coming in this time of year, and you know, wish everyone a great great rest of your week here.
Yeah, thank you so much. Have a nice rest of your day, guys. Bye.